Inventory valuation and its importance for bankers. Commercial banks, they give cash credit facility mostly against inventories, right? So when they give this facility against inventory, they are very particular about inventory valuation. Let's understand with this case. A Limited submitted its stock statement where the inventory value is mentioned as rupees 70 crore. When the credit officer called up for the breakup, he noticed the inventory is valued at market price. Whether anything is wrong here, we cannot directly jump to a conclusion now. We have to see in what context or in what scenario this was done. We have to see two situations. Here they have valued the inventory at market price, right? So now we have to compare the market value and the cost price. If the market value is less than the cost price, let's say they have valued at market price, right, at 70 crore. If market price is 70 crore and the cost is 75 crore, then what this business has done is correct. Why? Because the cost of the inventory for them is 75 crore, but now if it is sold in the market, it can be sold only for 70 crore, and they have communicated that to the bank through their valuation. It means valuing the inventory at market price is correct when it is less than the cost. Okay. So what is the benefit for the bankers here? Bank exposure is restricted to assets valued at 70 crore only. Here instead, if they had continued valuing the inventory at 75 crore, what would have happened is on the 75 crore, bank would have arrived at advance value, and on this they would have extended the CC limit. Right? It means bank would have also extended CC facility on the 5 crore. What is this 5 crore? 75 minus 70. Already the value had dropped from 75 to 70. But if the borrower had not communicated that, bank would have extended credit on this 5 crore also. So here what the company did is correct. Now let's look at the second scenario or a second situation. They have valued the inventory at market price of 70 crore, whereas cost is only 60 crore. So this is a scenario where they have valued it at higher price, right? Because the cost is only 60, they have valued it at 70 because in the market they believe they can sell it at 70 crore. But here what they have done is incorrect. Inventory valuation, especially while submitting the stock statement to the bankers, it should not be done at market price. Why? Because this 70 crore includes an unrealized gain. Because the actual cost is 60 only, it is valued at 70. 70 minus 60, 10 is an unrealized gain. Bank cannot fund on unrealized amounts. Okay. If the bank is going to accept the 70 crore, it means they are going to arrive at advance value on the 70 crore, of which 10 crore is a notional figure. Bank cannot fund on notional. Even though the market price is high, banks, they got to be conservative when it comes to funding against inventory. So the general rule is inventory should be valued at cost or net realizable value, whichever is lower. Net realizable value is basically the market price reduced by cost of selling the product, so that becomes the net realizable value.
Cash credit, overdraft, letter of credit, bank guarantee, term loan. These are all the major credit products which banks gives for business entities. And how these credit products are assessed, there is a science behind that. And we have taught all those in our comprehensive online course called Credit and Financial Analysis Mastery. And you can get a demo version of it by just commenting DEMO, comment demo, and I will share the demo link of the comprehensive course so that you can go through the course and take a decision about the enrollment.